Now, like a lot of you guys might already know, I've been buying shares of JEPQ, holding shares of JEPQ, and been getting paid dividends from JEPQ basically since the inception of this ETF. And honestly, I don't really have anything bad to say about this ETF. The ETF's offered me some capital appreciation since I started buying it. It's paid me income every single month, somewhere of around 8 to 10 to maybe 12%, depending on what time frame you're looking at. And the ETF is relatively low beta because of the option overlay. This ETF, like I said, has really done no harm. But regardless, I'm always still on the hunt for other ETFs that offer exactly what I'm looking for as far as my personal investment strategy and objectives. Now that being, I want to hold on to different stocks and ETFs that are going to pay me dividends, whether it's on a monthly, weekly, or quarterly basis. But also along with that, I want some potential for capital appreciation. I want my net worth to grow over time, and I want this all to be relatively tax efficient. So in today's video, I have a newer ETF that I just started buying as of recently that does offer all that and even does it better than JEPQ in some aspects. This new ETF that I'm talking about offers a monthly dividend around 11% more or less and offers some potential for capital appreciation because of its underlines. And it does all this very tax efficient. So if you want to dig into this new ETF that I'm talking about, then make sure to stick around, drop a like down below, and let's get right into it. My A to Z dividend investing ebook has helped countless dividend investors get started with their journey. And my custom dividend tracker that I'm constantly using here on the channel has also helped so many investors stay on track and allow them to see their dividend income in real time. Well, today I have another treat for you guys. I'm not only going to offer you my A to Z dividend investing ebook and the custom dividend tracker, but also just for a short limited time, I'm going to be adding in my brand new weekly dividend blueprint ebook to show you how you can get started with weekly dividend ETFs and add this into your investing strategy. This offer is not going to last long, so go ahead and click the first link down below in my description, and you're going to get both ebooks and the custom dividend tracker bundle. But like I said, please act fast because this won't be around for long. Now let's get back into the video. So the new ETF that I'm talking about is QDVO, or the Amplify CWP Growth and Income ETF. I have been talking about this ETF a little bit more as of recently. It came across my radar a few months back. I started adding a few shares to my portfolio, and it's relatively new. It started trading mid last year. Now I wanted to make a video about QDVO versus JEPQ because Kevin Sean from seekingalpha.com wrote an amazing article about the two of these ETFs and how QDVO likely to outpace JEPQ in the long run. I skimmed through it and I thought to myself, I have to make a video on this. This is way too good to pass up. And besides, a lot of you guys are fans of JEPQs, so I figured this would definitely provide some value to everyone. So it says summary, QDVO and JEPQ are both rated as buys. QDVO is expected to outperform long term, but JEPQ offers higher income at around 10%. QDVO's active management and tactical cover call strategy offers potential for higher returns as a large portion of its portfolio is uncapped. Now, QDVO's 95% ROC distributions make it more tax efficient for taxable accounts compared to JEPQ's ordinary income distributions. Buy QDVO in a taxable account if you value total returns more. Buy JEPQ if the sole focus is the size of your income stream. Let's read on. So first off, the QDVO versus JEPQ strategy. Comparing QDVO to JEPQ isn't quite an orange-to-orange comparison, as some may expect it, and is more like comparing tangerines to mandarins. Both funds seek to provide income while maintaining capital appreciation and use cover calls as their primary strategy for generating their distributions. Beyond this goal, however, QDVO and JEPQ take very different approaches. Most people are already familiar with JEPQ. The fund uses an active stock selection approach, but generally follows the NASDAQ 100 more or less, with most of its picks derived from its index. For its income component, JEPQ uses equity-linked notes, or ELNs, to get option premiums from out-of-the-money OTM monthly calls on the NASDAQ. While how much OTM is relatively unclear, the fund manager, Hamilton Reiner, has discussed in various interviews on YouTube that they continuously monitor their positions and adjust accordingly to lower the chances of executing unprofitable trades. Now, JEPQ's strategy has worked well and has generated $21 billion in AUM for good reasons. Yes, total returns ultimately did lag the Qs since JEPQ's inception, but the fund showed that it can maintain large, often double-digit distributions while growing its NAV. Now, QDVO also seeks capital appreciation and income simultaneously, but with a very different approach. The fund seeks a basket of 20 to 40 growth stocks, which I'm going to share with you guys here in a second, and tactically writes covered calls against individual positions. It's important to note that QDVO does not track the NASDAQ 100 and in fact does not have any ties to the index other than the number of coincidental overlapping holdings. QDVO basically has a curated basket of holdings. This is why QDVO and JEPQ is not an orange-to-orange comparison. Per its prospectus, QDVO's stock holdings actually come from the Russell 1000 Growth Index, which tracks large caps more generally. The result is that QDVO is less tech concentrated than JEPQ and currently has about 14 out of its 42 stock holdings that are not in the NASDAQ. Now, also important, QDVO's tactical cover call writing strategy is also very different from JEPQ's. Instead of systematically writing call options on an index every month, QDVO fund managers' option trades change monthly depending on market conditions and generally trade on their individual holdings. The goal is to provide 0 to 2% of gross income from dividend payments and 4 to 6% from selling call options. Since QDVO's inception at the end of August of last year, the fund has outperformed not only JEPQ but the S&P 500, the NASDAQ 100, and it's underlined the Russell 1000 Growth Index. Of course, we can't rely on 4 months of total return data to drive major investment decisions, but there are good reasons to believe that QDVO will continue to outperform JEPQ and perhaps even various indices. A big reason is the increased implied volatility in individual stocks versus indices. Higher IVs lead to higher option premiums, and when you combine the fact that 4 to 6% yield being very conservative from the calls in individual stocks, Coney, a yield max fund selling call options on coin, yields 139% currently, for an example. The fund managers at QDVO can reduce risk significantly by selling calls far out of the money and on small portions of the portfolio. For example, their current holdings cover a notional value of $5.9 million, which is about 26-27% of the entire fund's NAV. Now compare this with JEPQ, whose options cover close to 100% of its portfolio and are systematic in the sense that calls on the same assets are sold every month. Using historical NASDAQ 100 price data from investing.com, you'll find that the index has appreciated more than 1% about 55% of the time, 2% about 49% of the time, and 3% about 39% of the time. It should also be noted that the maximal gain in 1 month was about 25%. JEPQ's gains are always capped, which is why it ultimately lags in NASDAQ 100 over the long run. Now here's another very important part talking about taxes. And before I conclude this article, I want to discuss the factor that could be the difference maker between investing in either one of these funds. The factor is taxes. For those investing in taxable accounts, it is important to note that QDVO has an estimated to have around 95% of ROC distributions according to the 19A-1 notices so far, while JEPQ distributions are largely treated as ordinary income. With QDVO's sister fund DVO tracking close to its 19A-1 notices, we can reasonably expect QDVO to follow suit. The difference in ROC distributions and ordinary income can immediately make QDVO the preferred fund for income investors investing in taxable accounts. ROC distributions are generally not immediately taxable, and instead you reduce your cost basis. In other words, you're comparing an 8% distribution with the minimal taxes to a 10% distribution at your normal income level tax rate. Now, I did want to show you guys a little bit more in depth of this fund. So right now, for example, as of filming this video, there's 46 different individual stocks in QDVO. And as you can see, the fund manager individually sells covered calls on single stocks in the portfolio. And honestly, there's sort of a nice mix of stocks within QDVO, if you ask me, a little bit of everything. Some lower beta names like Verizon stock, for example, then some other names that are extremely volatile, names like Nvidia. All in all, like I said, QDVO has become a part of my portfolio. With a 10.29% distribution rate, at least as of right now, this ETF is offering a ton of income potential because of its underlying strategy. So now that we talked about QDVO and how it has the potential to outperform JEPQ and is potentially much more tax efficient, I also shared with you guys the fact that I personally started buying this ETF as of recently, just because it does match my personal criteria. I lastly, most importantly, want to hear from you guys down below. When it comes to QDVO ETF, even comparing it to JEPQ, what are your guys' thoughts on this one so far? Let me know in the comments down below. If you guys enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.